Good afternoon, everyone. I think I'm safe in saying that. It's afternoon just by a smidge on the West Coast. So good afternoon. My name is Geoffrey Smith. I'm, I guess, the chief instructor here at DTI. We are an educational facility teaching people how to trade in the stock, options, and futures markets. Don't mess that much with Forex, though I've traded in it. I'm really not that hip on it, but that's my opinion, and that's it. Great answers to all of those. I really liked reading through all those, especially Adam's. I kind of like that one myself. I don't like the experts have a tendency to kind of talk over your head, and you really don't understand what they're saying a lot of the times anyway. But one thing I've learned about a lot of them, they don't trade. And trading is a whole lot different than analyzing, yet we have to analyze to trade. So one thing I might add to that list is you need to know your risk. Everybody has different risk tolerances, and just because somebody decides to get into a trade, they might be willing to risk a little more than you. The one thing that I always look at when I look at risk is what does the market tell you you have to risk, not what I want to risk. And that's the one thing that I always evaluate my trades off of is what's the market tell me, and am I willing to do what the market tells me? And if I'm not, then I need to keep my little hands in my pockets. Otherwise, we can look to trade from there. A little about my background. I've been trading since about the mid-'80s, not full-time. I've been trading, I'll say full-time since 99, 2000. But I started kind of dabbling in the markets in the 1980s. My father went to the School of Hard Knocks, and he wanted to teach his two sons something about the market regardless of what field we went into. And so he kind of took it upon himself to teach us about the markets and things of that sort. He had a stockbroker, his name was Tom Busby, who was vice president of Smith Barney in Oklahoma City, that he talked into kind of helping him out a little bit. So Tom kind of took me, my brother, under his wing and kind of taught us a little bit, and they sent us off to an investor boot camp in Provo, Utah, put on by a gentleman named Howard Ruff. He actually used to have a newsletter called the Ruff Times. And we learned a little from there about the various markets and things of that sort. When we got back, my father sat us both down, wrote us each out a check for $10,000, told us we can make money with it or not, but he'd never give us another dime. And he held to his word. I went off and got a couple of degrees in engineering, was a pipeline engineer for about 10 years. But through that time, I was waking up at 3 o'clock in the morning. I was trading the S&P futures, NASDAQ futures early in the morning up until about 6:30. Then I'd go to work all day and get back in the evening, spend time with the family, go to bed, and do that day in and day out. Finally, the market had become a hobby of mine. And so when we started kind of getting really interested in the market, we started a school down here in Mobile in '96, and well, since then been kind of teaching and trading ever since. So that's a little about my background. As I stated, we are an educational facility, but we're also traders. And one thing in trading, there is risk. And the one thing we always have to do is manage the risk. The reward kind of comes in the end. But of course, past performance not indicative of future results, which at times that's a good thing. Other times it's kind of sad. But I'm not the best typist in the world, so if you do see a typo or something like that, just let me know, and we'll kind of go from there. I want to kind of tell you a little about us and the method that we trade, just so you understand where I'm coming from. And then we can kind of get into the 5-step process so you can understand it a little better and start going from there. As I stated, we started out in 1996, and we are an educational facility, but we have our own software. It's called our Roadmap software. It tracks the markets 24 hours a day. We do everything based off the index futures. You probably hear Bloomberg and CNBC, speaking of Adam's comment, talk about futures pointing to a higher open, or we're 7 points below fair value, or whatever it may be, and all they're doing is looking at where the previous day's close was, where the futures are currently trading based off the Asian and European markets, and saying, hey, at the time we're kind of up or down. I would say that Bloomberg's a little more accurate in the way they present it, because they actually say, hey, we are down or we are up. Everybody else says we're pointing down or we're pointing up. Which isn't necessarily the fact. We've already moved there. the one thing that you can't watch at night are the indexes themselves, and that's why we watch the index futures. They're a derivative of the indexes, so we want to make sure we know where our stocks are trading. Just like we can trade Toyota Motors, Potash, Alibaba, whatever it is, here on our exchanges. Those are foreign companies on our exchanges. They trade our stocks around the world. Well, if our stocks are moving, well, our indexes ought to be moving also. And but they're not, because they were turned off when the New York Stock Exchange shut down. So we have this 6.5-hour market here in the United States that our indexes are changing, but yet you have another 17.5 hours or so that they're not changing. And if you think about the amount of time that they're not moving compared to when they are, you've got 27% of the time they're changing in price, and the other 73% of the time they're not doing anything at all. So we're literally leaving 73% of the market off the table, which in today's world isn't probably a very wise thing to do, and that's why we track the markets virtually 24 hours a day. Now, granted, we can't stay up that late or that long, but we can be aware of what our markets are doing. Our support's not only for our software, but it's also trader support. Webinars like this are fantastic, just because you get to learn so many different techniques and things of that sort. We're always trying to learn. Even though I trade a specific method, I'm always interested in hearing other people talk. I learn something new all the time. We're always students of the market. We're never an expert, in my opinion. I don't know how people become experts, but I've been watching the markets for years and years and years, decades, and I'm still learning something about it each and every day. Just like today, we started selling off at the open. Everybody has their opinion why we went down. The thing is we went down. And in my opinion, a lot of times it doesn't really matter why. What really matters is if you're on the right side of the market. And a lot of people think that we ought to be selling off. Some people think we ought to be making new all-time highs again. And there's the battle between the bulls and the bears. And so we do have to be able to compensate for that, get our biases out of the way, and egos. So when we come in and start looking at things, sometimes we beat ourselves up in the market, and we need a little shoulder to put our head on and say, help me out a little bit. And really that's why we're here with our supports. We can, we've been through the school of hard knocks, been beat up in the market, but we've also had good times in the market. So, and that's why we are here, just to kind of help traders out or people out. When we start looking at the method that we go through here, we have three main elements. One is time of day. It's a 24-hour market. When we're in our evening here in the United States, Asia's open and trading. When I wake up in the morning, Europe's open and trading. And of course, during our day, we have our day market. But our morning market just isn't us. Our morning market also consists of Europe. Europe trades in our first 2 hours, so we have a lot of influence. And by the time we get to 10:30 in the morning Central Time, everything I do is in Central Time, Chicago time. I'm actually in Mobile, Alabama. But once we get to 10:30 in the morning, Europe shuts down, and well, a whole section of the world just left the marketplace. Our afternoon is just with the Americas, North, Central, South America, and we're the last ones to close our 24-hour market. So in time, the U.S. is the last market to open, last market to close. Yet people look at us as the forefront of the market. Kind of interesting that in time, we're actually at the end of the line. We have our key numbers, which are support and resistance in the market, but we let the market tell us where those are. We don't calculate them. And of course, our market indicators support our decision. We have different indicators throughout the 24-hour day. We have different indicators in the evening time as compared to the early morning hours, even into the U.S. market here. So when we divide up our 24-hour market, we have 4 separate time segments, if you will. One deals with the Asian markets between 5 p.m. Central Time and 3:30 a.m. Central Time. The European segment goes from 3:30 a.m. Central Time to 8:30 a.m. Central Time. And before anybody jumps on me a little bit here, the European cash markets open up at 2 a.m. Central Time. And in fact, the Eurex futures actually open up at 1 a.m. Central Time. We start watching the European segment at 3:30 because if you go to like Forex Factory or investing.com, you can see there's a lot of European economic news that comes out between 3 and 4 o'clock in the morning. Well, news is market food. And so if the food's good, things should go up. If the food's bad, things should go down. We want to get past their economic news to see what their trend's going to be. Kind of like when we start looking at our news that's coming out on Friday. We have that, the employment situation coming out is going to push our markets higher or lower. And that's probably going to be our trend for that day, whichever direction that news starts driving us. So same thing in the European markets. We want to see what their European news is doing to push them higher or lower. Of course, we get to our morning market here in the U.S. at 8:30 in the morning. We get the ding, ding, ding of the New York Stock Exchange and things of that sort. And we get to kind of see how that goes in to our lunchtime. We get past lunch and we'll just have our afternoon market into the close. You'll notice the close here isn't the cash market close. It's the futures markets close. They close out at 4:15 p.m. Central Time. The cash market actually closed out at 3 p.m. Central Time, so it trades for an extra hour and 15 minutes, if you will. Then there's a 45-minute break, and we start the next day all over again. So there's not a whole lot of time for rest in the market during the old work week, but we have to kind of carve out our own little times to relax our minds and things of that sort. This is actually a picture of today's market I chunked in here. It was earlier this morning when I had actually taken the picture. The S&P was trading up at 1964. Last I looked at it, we were right around the 1937 area, so it had sold off quite a bit. But this is a basic look at our software. In fact, since I'm sharing my screen, give me a second here, and there's a live look at it. We're down here at 1936 quarter now. But we use this to kind of track our 24 hours a day. And one thing I want to kind of show you here very, very quickly, this is actually a chart of the mini S&P. I don't have a little draw to it or anything like it. You'll notice it's horizontal blue line. This horizontal blue line is the open of our most current time segment. Remember those 4 time segments we just went through? And you'll notice a blue bar here. And that blue bar is the first 30 minutes of that time segment. You notice there's a blue bar back over here. This was at 8:30 in the morning when we went, opened up our U.S. markets. Back over here, that little blue bar is the European markets, and this little blue bar over here is the Asian markets. You can kind of see last night we actually went up a little bit in Asia. In Europe, we started selling off, and of course we've been going down all day. So we actually had an up Asian market, not by a whole lot, but by some. And we were starting to trickle off throughout the European markets, and of course we've been selling off here in the U.S. just basically all day long. I noticed some people kind of blamed our down move here on the manufacturing news that came out 30 minutes after we actually made the down move here. So you notice after the news came out, they actually rallied it back up a little bit. So they were saying it's worse than expected, yet we kind of popped back up about 7, 8, 9 points in the S&P before rolling back over after the European cash close. They're at 10:30. But we can kind of follow in each one of these little individual time segments here how the market is beginning to trend. Now we can use this bar as kind of a breakout bar, if you will. If we start breaking below it, odds are we'll continue in that direction through that time segment. You'll kind of notice we kind of took out the highs here. We kind of went up. They kind of popped up here a little bit, but they started pulling things back down, and of course we've been down this afternoon as well. But we can actually use the software to kind of track the markets 24 hours a day. Now if I can get back to another, there we go, our little PowerPoint here. Kind of get into the let me make one little footnote here. We use everything, just kind of pointing out to you, we use everything based off of open. We don't like closes. The reason for that is the close is the end of the race, not the beginning of the race. And I, in trading, always want to know who's winning, not who won. Anybody can go back to yesterday and say, well, you could have gotten long here, no hindsight trading. The thing is, we're trading the hard right line, and we're trying to figure out if things are being more positive, things being more negative, and we go from the open just to figure out who's winning now. Not only that, but the markets can gap around a lot. You think about at 3:30 in the morning, that's basically when Hong Kong closes out. They actually close out at 3 a.m. We were up at, the 1961, 1962 area in the S&P at that time. We're down here at 1936. So Asia has not seen our sell-off today. So tonight when they open up, they're going to gap down. And if you think about where they closed early this morning at 3 o'clock, they're going to gap way down when they open up. Well, they could rally in their market all day long over in Asia and never get back to that previous day's close. And when you wake up in the morning, you're going to hear Asia was down. But the question is that I have is, was it really? Because if you would have shorted it at the open, would you have made money? And that's why we do things off of open, because it kind of removes the quote-unquote gaps in the market so that we can see if things are really still trending down or if things are still trending higher. We're traders. We're trying to figure out if things are going higher or lower here. You want to stay with the trend. Yeah, the trend was down, but are they rallying it during that little time segment that I need to be looking to go long instead of going short? So we do things based off open. When we start going through kind of a trading process, if you will, we need to start looking at how to pick the right market, analyzing trades, long, short, risk, reward. And I will kind of expand on that a little bit, and how to execute things somewhat. And I'll show you a cool little trading platform to kind of help things out a little bit. First of all, picking the right market. I always go based off of time, what time of year is it? Because depending on the time of year is basically what you might shift into. You've probably heard of when in May go away, which that didn't work this year, I can tell you that right now. If you went away, you left a lot of money on the table, but a lot of times you'll see equities perform very, very well from about the middle of October, beginning November, up through the April-May time period. And then things just kind of chill out and chew around a little bit as we go through the summer months and into the early fall, and then off they go again. You'll see commodities, and I'm talking about the wheats and the corns and the soybeans and the various meat products, live cattle, lean cattle, things of this sort. They all have a tendency to move from about April to October, kind of during the time period that equities don't. And the reason for that is we have all of our harvests. We go to slaughter in about September, October on the pigs and the cattle and things of this sort. So we have these various things happening in the commodity markets as opposed to the equity markets. Usually, not always, kind of like this year. But we hit our harvest lows in June, July, and then we usually start to kind of bounce back up a little bit, unless you have record crops like we've had the past couple of years and things are continuing to sell off. The time of month is really important. There are different news items, and in fact, if you look in general at the economic news that come out around the world, you'll notice that most of the foreign markets have most of their economic news in the first 2 weeks of the month. You'll notice most of our big economic news, except for the non-farm payroll number, is usually in the last 2 weeks of the month. So we have most of the world getting their news out in the beginning of the month, and we usually get things out toward the end of the month. You get a little overlap in there, but depending on the time of month, you might see foreign markets moving more than our U.S. markets just because of that. Of course, it's a global marketplace, I understand that, but you'll usually see a little more reaction out of their markets. Time of day. We get economic news at 7:30 a.m. Central Time, 9 a.m. Central Time. So we need to be aware of when those news come out. So really, depending on your time of year, time of month, time of day, you might be shifting from one trading vehicle to another. Do you trade the commodity markets or ETFs on them? There's nothing wrong with that. Or do you trade more of the equity markets? Is it a dividend playing kind of thing? Do we need to just be focusing on news because when there is no news, the markets aren't doing much? And just depending on the current economic times or who's speaking today, we might be having to wait for the best time to trade. So we also need to be kind of looking at how markets quote-unquote synchronize themselves. I threw this in here just to kind of give a feel for how I like to see things move. More of a kind of a predictive market, if you will. And why I say that is one thing that I noticed back in the early 90s, mid-90s, was when you hear that the S&P and the Dow and the NASDAQ, they always quoted the prices on the radio or on TV or whatever it was. Well, they always happen to be up together. they always happen to be down together. Once in a while, you'll hear one of the indexes that was kind of out of sync, but usually you had at least two out of those three in the same direction. And I got to thinking, what makes these things move up and down together? You look at the S&P 500, and you could argue all the Dow was in the S&P 500, but not all the Nasdaq's in the S&P 500. And at the time, none of the Nasdaq was in the Dow. Now you've got three guys in there from the Nasdaq. So all of a sudden you start scratching your head trying to figure out, well, there's no banks, there's no financial institutions in the Nasdaq 100. That's one thing that you cannot be to be in the Nasdaq 100. But yet the other two indexes had, banks and mortgage companies and all that good stuff. So they're really kind of different animals, if you will. So instead of me trying to figure out which stock moved it the most and all this good stuff, I went back and started looking at relative moves. I ran track back in high school and college, and I got to thinking, all of them move a certain distance in a day. Now, they might not all move the same distance in a day, but it's like a race that you're giving a specific time to run. Instead of saying, okay, when the gun goes off, run, whoever's ever across the finish line first, whoever's across there first wins. They say, okay, you get to run for 5 minutes, and the furthest one wins. And that's basically how the market works. It goes ding, ding, ding at 8:30 in the morning, and then at 3 o'clock in the afternoon, you hear another ding, 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 and, well, that's the end of the race, right? So I started looking at their average ranges. And what this thing is showing you here, this little mini pivot is the open of our current 30-minute bar. Like I said, those charts I was just showing, they were all 30-minute charts. So I want to know where we start out on the current 30-minute bar. The ETR line, it stands for electronic tape reader, is where we're currently trading. And the line just below there is that change. 44.5 down to 43 is a 1.5 in the S&P. This is the Dow, this YM. We went from 44 down to 33, it's 11 points. We went from 88.25 down to 86, which is 2.25 points. So we get the actual change here, how much it's up or down. And notice the next line says predicted. And this is where that ATR thing I was talking about comes in. Let's go down to the very, very bottom of this page and I'll show it to you. You have the 14-day ATR. And the reason why I use a 14-day, I used to go to barchart.com all the time to find out what the ATRs were. And they have a 9, 14, and 20-day ATR. Well, ATR is average true range, so it's an average. And I started noticing that if you average the three of them, the 9, the 14, and the 20-day ATR, the 14-day ATR is kind of the average of the 9, 14, and 20-day ATR. So I thought, what the heck, I'll just use the 14-day ATR. Nothing scientific behind it, just something that I kind of noticed. It's not exact, but it's pretty close. So I started using the 14-day ATR. And the S&P right now moves about almost 21 points a day. The Dow 177, the NASDAQ 51, the DAX, which is like our Dow, but it's just in Germany, moves 134, 135. The Euro Stoxx 50, you can kind of compare it to, I don't know, what has 50 stocks in it, the Fox 50, if you will. Now, this is across the whole Eurozone, and they take the 50 largest companies across the Eurozone, the European Union there, and say, okay, how are these guys doing? So we get to look at the DAX, which is in Germany, which is the largest economy, and then we get to look at the whole European region there and to see how the whole European region is going. If you go back to when Greece and Spain and Italy were all having some sovereignty problems, the Euro stocks got hit a whole lot harder than the DAX did. And you'll see those relationships just depending on where the index is. And of course, the very, very last one here is your Russell 2000. But we can kind of look at those average ranges, and I'll put them all in terms of just the S&P, which is this first column here. So for every 1 point move, and it moves in quarter-point increments, and it has, of course, like I said, about a 21-point range in a day. For every 1 point move in the S&P, the Dow moves 8, the NASDAQ moves about 2.5, the DAX about 6.5, the Euro Stoxx 2, and the Russell about 80 cents. So all of a sudden, I can sit there and go, well, if the S&P moves from point A to point B, and everybody's holding hands moving in synchronized motion, I should see the Dow move about 8 points, or whatever from point A to point B is in relative terms. And that's what this predicted line up here is telling you. If the S&P moves 1.5 points, the Dow ought to move 13. If we move to 1.5 points, the NASDAQ ought to move 3.69. Moved to 1.5 points, the DAX should have moved about 9.7, and so on and so forth. So, but this difference line here gives you the difference between them. And of course, S&P is 1 for 1 for itself. But notice the Dow went down 11, but should have gone down 13. So there's it's 2 points stronger, if you will, than where it should be. The Nasdaq went down 2 1/4, should have been down 3 1/2, 3 3/4. So it's about 1 1/2 points stronger. The DAX is 1.7 points stronger. Notice they're all stronger than what the S&P has done here, which tells you something. The S&P is the weakest market. If you're trying to buy something, you buy one of these guys. If you're trying to short something, short the S&P. Well, since we're down, the S&P is probably the best one to sell just because it's the weakest market. Not by a whole lot, no, but it still is trying to lead the rest of the markets down. So if all of these were negative, the S&P would have been the strongest market. So I can put, any number of stocks, equities, or you can even do this based off the ETFs. You can put the SPY, DIA, QQQ, and so on and so forth across here, and throw in Disney, Apple, IBM, Netflix, whatever you want to across here, and find out all their relative moves to each other, and figure out, well, okay, if I'm trying to, and I saw somebody make a comment of trading in the first 15 minutes of our market or the first half hour of our market or something like that before I started in here. You'll find out very quickly from the 8:30 a.m. Central Time open which stock is being the strongest stock, which one's being the weakest stock. A lot of people get married to one trading vehicle. I'm just I don't know, grab one Priceline trader. I'm just I like to trade Cummings off the open. There's a lot of people who get stuck on just one entity. As traders, we have to be able to be versatile, and sometimes the one thing that I'm trading isn't moving very well today, so I need to be trading something else. And it's a lot easier to make money on something that's wanting to go in one direction as opposed to fighting it. And that's the one thing I've realized. There are times, this little Russell contract here, Russell Futures, I don't know if anybody's ever traded it. I can't stand the thing. If it fell off the face of the earth, it wouldn't hurt my trading at all. I don't care for it at all. But there are days that I will trade the Russell just because it is the weakest market, or it is the strongest market. It's kind of like carrots. If you don't like carrots, sometimes you eat them just to be polite. And it's the same thing in this. A lot of times I'll trade the Russell just because, well, it's the strongest or weakest market. It's the one that's going to pay you in the direction that you're trading. And that's why I keep it in here. I try to keep as many things as I can in here just to figure out who's strong, who's weak. These are all index futures, if you will. But you can pick all kinds of commodities, or like I said, ETFs, or just equities themselves in here. And you can start figuring out which ones are the stronger ones, which are the weaker ones. Even if you're an option trader, you like to trade options off of the 8:30 open. You can find very quickly which underlier is moving the most to the upside or to the downside. Flip over and buy a call or buy puts or whatever it is, depending on direction, based off what's going on. And you don't really have to worry about the Greeks, if you will, because if that underlier is moving, odds are the option's moving as well. Now, one thing you have to worry about in options is time decay. So if you're doing weekly options and it's Wednesday or Thursday, you either have to do deep in the money or you have to go out a week or so. But besides that, you can find out very quickly how that underlier is actually moving. And that's one thing that I'm looking for when I start trying to figure out which market to trade, is really who's strongest and who's weakest in a market. So, of course, we have to analyze our trade. We need to figure out what the overall trend is to start with. I heard, saw somebody here, so the trend is your friend, trade the trend. Absolutely. So what's our current weekly trend? Well, here we are on Wednesday afternoon. How we've been doing this week. We've been down, right? So the trend is down. Of course, our daily trend was definitely down, so it was agreeing with the weekly trend. The biggest thing is, do they coincide? Because we can have an up day in a down week. We can have an up week in a down month. And so we do have to kind of take that into consideration. If we don't want to be long because the overall trend is down, when I start looking at a market, I always start with a weekly chart. I want to see what its humongoid trend is. Has it been trending up for the past, 8, 9, 10 months, or been trending down for the past 8, 9, 10 months? And then I'll pull down to a daily chart and going, okay, does this trend agree with the weekly trend? And then I go to an intraday chart and say, well, does the intraday chart agree with the daily chart? Because if they're all three coincide with each other, the trend is going to be a whole lot stronger. If I'm having a down day with an up week, up month, and up year, well, I might be trying to fight things a little bit. So I might not put as large a position on just because of that. So you do have to kind of take into consideration what those different trends are and if they're all trading in the same direction. That's, like I said, every time I start looking at something, there's actually pages, kind of like an Excel spreadsheet in our software. I keep a weekly page, I keep a daily page, and I have an intraday page, if you will. So I can very quickly just go click, click, click between the, the pages and go, okay, down, down, down. Is today down? Yes, short it. You'll have a whole lot better chance of making money as opposed to trying to say, well, I think this is the lowest they can go and try to buy it, and then you get stopped out, and then you're trying to fight the trend of the market. So I always like to stay along with those trends. Of course, we do have to answer a question. And actually, there's probably a three-part question here, long, short, or out. Sometimes out is a great trade, though it's really not trading, but we get to preserve our money for something later on. You really don't want to fight the trend. And of course, as I was saying, does the day agree with the trend, the bigger trend, weekly chart, daily chart? And you get paid a whole lot better the longer you're in a trade. Every trade I get into, a lot of people sometimes will accuse me of being one of those nasty day trader people. I do trade intraday. I swing trade. I also trade very long term. And every trade I get into, I'd love to hold on to it for 12 years there. But a lot of times the market won't let you. And if you look at down markets go a whole lot faster than up markets. So some vehicles, I'd rather be short than long any day, just because they go down a whole lot faster than they go up. But down markets don't last very long either. So we have to be very, very, very careful. If you took the number of years that the S&P is down compared to the number of the years that the S&P is up, there's a whole lot more up years than down years. So we have to be very careful on the downside, even though we might get paid better, that the market still, this path of least resistance is up. And probably the biggest reason behind that is all of your retirement accounts, 401ks, and all that stuff. Everybody's buying into stocks, which buoys it up. So you'll really find equities, their path of the least resistance, probably is the best way of putting it, is to the upside overall. But when it comes to futures, really they'll move down a whole lot more than they'll move up. They will struggle moving higher, but they have no problem just tanking off. If you looked at crude oil today, from when I'll say when Europe opened this morning, it was just chugging higher, just slowly moving up and up and up and up and up and up. Even after the EIA petroleum status report came out today, crude oil and gasoline both popped up a little bit just because the inventories were down. But one thing is their overall trend is lower. You look at where we started out the year, the month, whatever you want to, we're down. Now, I guess I should be talking about last month just because today was the first day this month. And they've been popping it up off that news, but usually they'll start rolling it back over and selling it back off. And that's exactly what happened today. Here's crude oil right here, and as I said, it was just kind of chugging, going up. And after the news, they just tanked it back off, going back with what they've been doing, which is kind of selling things off in the crude oil and gasoline markets. So the thing is, you need to really pay attention to what the bigger trends are. We have had production in oil just in the United States. We hit a 27-year high in production in July. We have literally exported more oil this year in 2014, more oil than we have since 1957. That's a long time. So our production is very, very high. They don't have any place to put it. That's why they're starting to export it. And we kind of have a rule. We don't export oil, yet we're needing to because we don't have any place to put it. So they're shipping it over to South Korea. They're shipping it to various places, even keeping it in tankers out there in the Gulf, just because we don't have a place to put it here. And that's the thing. Even OPEC is cranking it out. So we have a lot of production. So if we have a lot of supply, that the demand remains present, things are getting weaker. Thing is, crude oil won't get below 90 bucks. I wish it would. But anyway, but we have to look at every single one of these markets and try to gauge, are they moving higher or are they moving lower? And we want to stay with those overall big trends. Of course, when we start looking at risk versus reward, this is kind of an interesting little equation. A lot of people say, well, this is where my stop is, this is my profit target, that's risk and reward. I thoroughly disagree. Just because there are a lot of times that you have to put your stop where the market says it is. But think about this very quickly. Definition of a good trade is what? One that never goes against you. Definition of a bad trade, whenever it never goes in your favor. So if you get into a trade and it never goes against you, what's the stop matter? You could have a 1-point stop, you could have a 10-point stop, you could have a 90-point stop. It really doesn't matter. So it's not where the stop goes, where your profit target is. It's the odds of the trade working. Is the time of day good? Is your entry price a good entry price? Is your entry price a bad entry price? And that's where, learning, experience, and things of that sort come in. There are some trades we get into that, we got in and it never looked back. It was just the most awesome trade in the world. There's some of them that you get into and you bought high tick. You're like, oh, really? Come on. And then we get to be a cheerleader, right? So the thing is our analysis says this is what the market should do. There are a lot of times, I'll get into a trade, and I might be risking, 6-7 points in like the NASDAQ futures to see if I can't make 3 or 4. So the risk reward is totally backwards to everybody's mind. But the odds of the trade say it'll work. It's just that I probably can't get a whole lot of profit out of it just because, well, I'm running up against the high or the high of the week or something like that. So there's not a whole lot of room, but if they challenge it and they break it, hey, I can get paid a whole lot more. And so there are a lot of times I'll get into a trade that I might have to risk more than what my target is, but the odds say it's a whole lot better. So one thing you can kind of do if you're trading intraday, if you really want to figure out what the risk of the market is, go out and look at the past 3, 4, 30-minute bars, see what their lengths are. If you're seeing that the average length of a bar in the S&P is 6, 7, 8 points, well, there's your risk in the market. It's 6, 7, 8 points. Now you're willing to risk 6, 7, 8 points to be in this market because you can try to tell the market, I'm not risking more than $100 on this trade, or I'm not going to risk more than $250 on this trade. Well, the market doesn't care what you're willing to risk. The market's going to go where it's going to go. So you're going to have to risk what the market tells you to risk. And that's what a lot of people don't like doing, is letting the market tell them where their stop is. We can use time to adjust it. We get into a trade, it goes in our favor, and it starts going and going and going. We might be able to adjust our stop using the little swing highs or the swing lows off of a 5-minute chart or a 30-minute or 1-minute chart or something along those lines. But when we start looking at risk and reward, always look at what the market's telling you to risk. Don't try to tell the market what you're going to risk, because a lot of times that doesn't work. I see a lot of people say, I'm getting long here with a 1-point stop on the S&P. Well, okay, good luck. You might get lucky. But 1 point in the S&P is nothing. They can move a point in 10 seconds. If they make it, great. If not, well, I don't know why they put a 1-point stop in. The market might be telling to risk 4 points, and then you go back and look. They got stopped out, went 2 points against them, and then would have paid them 3 or 4 or 5 points. They put their stop too tight. So you have to be very, very careful about where your protective stops go. Do it based off market performance, not off of, well, what you don't want to risk or want to risk, whichever it may be. So, and to kind of help reduce this a little bit, and I want to kind of show you something here very quickly. And this is one thing that, happens to me every now and then. It just burns me up. You get into a trade and you put your stop in and everything like this. You have a plan. Think it's going to go from, let's just say from 100 to 105, whatever it may be, just throwing some numbers out there. And you're like, okay, here we go. And before you know it, it comes down and it stops you out. You're like, dadgummit, I swear it was going to go up. So you turn around and you start looking at other stuff and doing other things. You turn back around, and dang if it didn't go to where you thought it was going to go anyway. And it's just that, well, either you had your stop too tight, you had the market just moved more than what was expected, whichever it may be, or maybe you were trading during news and you got into the news jiggle, and it kind of beat you up a little bit. Well, they came out, I don't forget, it's been a couple, 3 years now. They have this thing called Nadex. And Nadex is a kind of a cool little thing. And I wanted to kind of show everybody what Nadex was, just to kind of give you a feel for what it can do here. Time is 2:45 Central Time, so we have a little bit of time left in here. This is the Nadex platform. Literally, it's off the web. You go to nadex.com, you can make an account. You don't have to put more than like $100 in this thing if you want to. And don't get scared here, because I'm going to say 2 words and a lot of people scream and yell and run. These are binary options. There, I said it. Now scream and yell, but don't run, because this is kind of a neat little thing. I'm going to go over here. I'm on the far left side of this little menu. If you have bull spreads, you have indices, binaries. And let's just pick the, I don't know, the Dow 30, Wall Street 30, and we'll use just today's little spreads here. Might have to scroll down. They might not have any left. Well, I guess they got a few left here. The index over here in this far right column is at 167.47, and you'll notice we have 167.50, 167.70, so we're actually below all these spreads. We had a big down day today. We might be able to see something a little better in the S&P. Where is it? US 500 daily. Let's see if this gives us something a little better. We're at 41. Yeah, they have 34, 37, 40. So we have some little bit of room in here. One thing you'll find here, we're trading at 41. They have a 40, so we're a little bit above that. We're below the 43. But if we were trading down at 40, you'd probably see the bid and the offer here, and that's what this red and blue is, right around 50, okay? But since we're a little bit, and we're at 42.5, 42.25. So notice you'll get in this 43 here, just really close to 50. Basically, it's a 50-50 chance. But notice the little signs over here on the strike prices. Notice the little sign there. It's a greater than sign. You see that? So basically what you're saying is this. Binary options are agree, disagree, yes, no, true, false questions. Will the S&P be greater than 1943 by 4:15 p.m. Eastern Time? Basically, that's in 30 minutes from now. And if you agree with that, you can buy this. If you disagree with it, you can sell it. Okay? And this 42 by 48 is in dollars, so that's $49 or $51.50. When a binary closes, it's an intraday binary, it's either at 100 or it's at 0. So depending on where you buy it or sell it at, the difference of where you buy it and sell it at, you'll either get a payout of 100 minus what you bought it at, or a payout of 0. Of course, if you sold it at 50 and it went to 0, you get to get $50. So that's what it is. It's an agree or disagree. So going back to what my point was earlier was, there are times where we get into a market, think it's going from point A to point B. Well, it goes there anyway, but it sold off, stopped you out, whatever it is. You can come into Nadex and say, I don't think the S&P is going to stay down here, at such and such price. I think the S&P is going to close above 1946 today, even though we're down here at 1937 or 1935 or whatever it was. And you can go out and buy this 1946 binary, and at the time it was probably pretty cheap. It was probably down at $9, $10, $15. So you're spending $15 or risking $15, let's put it that way, to see if you will get paid 100. If you're right, your net profit is going to be $85 if you paid 15. If you're wrong, you lose $15. That's on just one contract. And what's really cool here is you can actually put in an order and say, I'm going to buy this. Let's just do a one lot so you can understand the math a little better. We're at 1950 by 22, but if we buy this thing at 1975, they're telling you down here, your max profit's 80 1/4, your max loss is 1975. You can actually place this order and to argue that, hey, that's what's going to happen. Now, up here at the very top, it tells you this is the greater than 1946. If you're at 1946 even at the close, you will lose. It has to be greater than. It's not greater than or equal to. It is greater than. So, but you can use Nadex to trade those. One thing, what I really like about Nadex, these are the indexes and all, but you also have Forex, you also have commodities. You can do copper, gold, silver, coin, soybeans, natural gas, crude oil. You have the EIA Petroleum Status Report that comes out on Wednesdays. You have the natural gas report that comes out on Thursdays. So you can actually trade this. You can even trade events. And you'll notice this is your non-farm payroll, which is Friday. This is your jobless claims. And what they'll do is they'll tell you, just to show you here what these events are. There we go. Non-farm payrolls greater than or equal to 270,000. If you think it will be, you can buy that binary, and if it is, you make money. If not, you lose money. There it is. So you can actually use Nadex as a very, very, very low-cost way to look at saying, I think this market will do this, or I don't think this market will do this. If you don't believe that we'll close above 1943, you can sell this for somewhere around 40 bucks, and if you're right, you get $40 a contract. If you're wrong, you'll lose $60, of course. So, but that's just it. You can use Nadex as a very, very low-cost way to see what this market's going to do. And that's one thing when we start looking at risk and reward, how can you minimize risk to maximize reward? So a lot of times I'll come into Nadex and trade the Nadex saying, I think this market's going to do this by the close. And one thing you'll notice in here, I don't know if we'll be able to see it just because the time's already passed, but you'll notice this is the S&P 500 here. And notice this is between 2 p.m. and 4 p.m. This is the daily and the weekly. If you would have looked at this earlier, you would have probably seen between 9 a.m. and 10 a.m. Or 9 a.m. and 11 a.m. or something like that. And these are all Eastern time. And so you can look at these little bands. So you can actually take a a speculative guess that says, hey, I think this is going to be above here by this specific time. But if you want to see how the thing's going for the week, of course you can do the weeklies, just like weekly options. You can argue that we'll be back up at the all-time highs in the S&P up here at 2007.5 by the end of the week. Probably wouldn't try to buy that one just based off the week performance, but you never know. Last time we went down to the lows, which was back at the beginning of August, down to 1890. Literally within 3 days, we were back above 1960. We just went boom, 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 straight up from there. So they can move these markets very, very, very quickly. But you can use Nadex to trade it based off of a weekly trend, a daily trend, monthly trend, whichever it may be. You got commodities, you got Forex, and you got your index futures or indices that you can kind of play with. So if you don't want to pick a specific stock, there it is. And it's a good way to kind of introduce yourself to other markets as well. So anyhow, I guess, wow, we've already gone just about an hour here. So didn't realize until I just saw the clock. But anyway, but I would strongly recommend playing a little bit with Nadex. The orders and everything like that are very easy to just click on it, and it'll tell you what your risk is, what your maximum profit is. You can even do the spreads. If you think it's going to be in some sort of a range in this day, you can buy that spread to say, hey, I think it will be in this range. If you don't think it's going to be in that range, you can sell that spread, and if it falls out of that range, then you'll make money that way as well. But it's a kind of a very, very low-risk way of entering into a market. So anyway, there's that is. Speaking of news, since I'm beginning to run out of time here, on Friday we do have the employment situation. Every month the non-farm payroll numbers come out. News is a market-moving event. One of the most volatile news events of the month by far. Of course, if we have the Fed coming out, we can have a very, very volatile market. And what is that? The 29th of October, we have the another Fed announcement. We also, tomorrow morning, have the ECB and the BOE coming out. ECB is the European Central Bank and the Bank of England. So they get to do their little news announcements. So you'll probably see the Euro or the DAX or the Euro stocks moving around quite a bit based off of their little announcements. But there's various news announcements that we'll have throughout. We have earnings coming out this month, right? So individual stocks are going to be moving around quite a bit. So we like to trade based off what news does, just because, well, markets have a tendency to move that way. And one thing that if you want to come to one of our rooms to see us trade the news, I will be in there trading on Friday morning, seeing if we can't get long or short. It moves so fast that we have to kind of give it a little time here, but we might be getting into the we're trading basically the index futures because, well, it's all that's trading at that time when that news comes out. But if you're wanting to come join us, feel free to do so on Friday, October 3rd, day after tomorrow, 7 a.m. Central Time if you're on the West Coast. Yeah, it's kind of early, but I'll start up about 7 o'clock in the morning, 8 a.m. Eastern Time. I'll run through how I'm looking to trade the news and how we're going to look to kind of get long or short if we can. There's no guarantee that we can get into it. Heck, it might not do anything. I've seen the employment situation not do a thing at all. But if we can, nice, then we will see if we can't get long or short based off of that. Otherwise, we'll see if we can't trade something else. We might be able to get into the dollar or bonds or something like that. But if you want to come join us, use that little link down there at the bottom, dti.infusionsoft.com. And I don't know if you can click on that or not, but if you can't, maybe I can type this thing in here. Actually, do I have it over here? I can probably just paste it in there. I think I have it somewhere. There it is. I will hit enter. There we go. You can use that link right there. Of course, you can call us here at 800-745-7444. We'll be more than happy to help you out. What is the lowest time frame with Nadex? Like I said, a lot of times they'll give you an, like a little 2-hour spread. I think 2 hours is about the smallest time period that you have in that. But you get those in all the commodities. One thing is remember everything's in Eastern time in there. That screws me up sometimes because I'm so used to Central time. Remember everything's in Eastern time. And when it closes out, literally the last minute, they won't let you trade it because they let it settle out and figure out where it's going to be. But it's kind of a cool little market to trade. So and with that, if there's any questions, I'll be more than happy to answer them. Otherwise, I guess I'll wrap things up here and start going from there. Dan, I guess I can kick things over to you.